Thank you very much for being here with us. I think the men on the panel need no introduction whatsoever. They have been enlightening us for years together. Let's put our hands together for the first panel as we look forward to hearing from the masters themselves. So the theme of the panel discussion today is riding the bull, surviving the bear, and where we are right now. Let's get started. Let's set the ball rolling. First with a take from the author, one of the authors as well, as to how this whole experience was interacting with these gentlemen. And let's say if you were to put it in a nutshell, your insight, your learning, what would that be?
Actually, we have put a whole chapter about our learnings at the end of the book. There are quite a few to enumerate here. But to take a few, one is about being bullish as far as India is concerned, to be investing for the long term, because otherwise, at the first problem, whether it is a political thing or from an economic standpoint or a market cycle standpoint, one tries to time the market and it doesn't work. Major wealth is created when you are invested over a cycle. It's very simple, means we have heard it so many times, but unless you inculcate it, it doesn't work. So that's one. Another is in terms of how you look at stocks. So you have a limited time, but what are the stocks or what are the key things to focus on, like growth, ROE, free cash flows, capital allocation. So if you focus on 4 or 5 key metrics, it becomes relatively easier to sort of look at the whole universe and figure out what would do well over the next 4 or 5 years.
Okay, we will talk a lot about some of these concepts as we go forward. Let's also look at the theme itself, since that's what we are here to discuss. Mr. Iyer, first of all, riding the bull, surviving the bear, and where we are right now. Let's answer that last bit of the question from what you can sort of derive out of it.
We're definitely not in a bear market now. If you look at what happened in the last week itself, you had an RBI governor resigning, you had the BJP losing the elections, and you had a new RBI governor people are not sure about, and still the market went up. So I would say we are in the middle of a bull market. What phase of the bull market, I don't know, but we are in a bull market.
Raamdeo sir, you agree?
Yeah, kind of. This is a very different kind of bull market, but I still call it bull market because there's no earnings growth, and yet markets are going up. So it's an earnings-less kind of a bull market where you're stretching the same stocks, 30p, 40p, 70p, but it's a bull market, yeah.
Does that worry you?
Yeah, it doesn't excite me because the fun is to buy cheap stocks and lots of them. But today, wherever you go after doing the book, after doing the screener and everything, and when you reach there, you realize that you are the last guy to reach there. Already 100 guys are there. So I think it's a very deeply researched market and fully, I would say, priced in bulk of the stuff where I could reach so far. So kind of not that exciting.
Not that exciting. All right. Hiren, opening thoughts. Where are we?
I certainly feel that we are in the midst of an uptrend. To me, I think 2018 second half was very much like 2013 second half, right? I mean, you had a few macro headwinds back then. I remember Mr. Chidambaram was brought in as the finance minister and Rajan came as the RBI governor. The rupee depreciated by 20+%. Small and mid-cap stocks corrected very sharply. There was elections in 6 months. So very similar setup in 2018. You had the oil prices going up, currency coming down, worries about Fed increasing rates. On top of that, you had the IL&FS problem. So you had a perfect storm in August, September. And usually a perfect storm is where the bottom is really made when there is no visibility and people are scared. And now there is election 6 months down the line. So such similarity. And I tell investors that, history is a great lesson. Whoever invested in the second half of 2013 was laughing all the way to the bank in 14, 15, 16, 17. The only difference I feel, as Raamdeo rightly mentioned, that in 2013, markets were incredibly cheap. This time around, markets are not that cheap, right? So it's that much more difficult. But as investors, as long-term investors, you should always welcome a crisis, because at least now I think, if nothing else, a crisis is what will give us an opportunity to pick a few stocks. And that's what happened in August, September.
But this crisis hasn't been shaved off over like 10% from the top. I mean, for this year, despite all the ups and downs and all the events that you gentlemen touched upon, we're still actually up in positive territory for the calendar year and for the 12 months. So, Mr. Iyer, your thoughts then on then if this is indeed a bull market and prices aren't correcting as much as you perhaps like them to, how do you make money?
Actually, prices have corrected. I mean, if you look at what happened to the mid-cap about a little less than a year back, they've corrected a lot. And if you look at the overall market itself, it's gone down by 20%. It can happen in the middle of a bull market that leadership changes. And I think that's what is happening. So some of the stocks which really led the bull market in the last 2-3 years are very, very expensive. I mean, so... But I think there are other companies which have been ignored which are doing well. So I don't see the market overall might look overvalued in terms of the index itself. But I think there is enough pockets of value inside the market.
Since we're already on the valuation subject and argument, this whole classic debate between buy growth at any price or buy growth at a reasonable price, but then what is reasonable? I mean, how do you evaluate the sustainability of that growth? How do you negotiate some of these issues? Raamdeo, you want to take that?
Yeah, so valuation is a large subject and, particularly in this kind of time, as I said, it's not that exciting because all the stocks where there is a longevity of growth and stability of the return, those stocks are kind of more than fairly valued. So, as you said, growth at any price. Of course, in investing, if you buy at any price, you're not going to make money. Or you're going to make less than even fixed income money. Like if you make we have seen this wealth creation study is only about valuation. So there we have seen if you buy at 3 times growth, so if growth is about say 20%, you buy at more than 60 P multiple, your returns are not going to be as much as even the market. You'll underperform the market, howsoever good a stock you buy. So if that is so, you can decide, so what is going to happen if you chase this highly valued companies in your portfolio because they look very good, your portfolio looks very decorated, you feel very comfortable. But I'm quite sure after 5 years, the return from the same stocks in the portfolio would be, say, if market has done 11%, you'll do about 8-9%. So that kind of risk is there. So if you want to really make 15-20%, you have to make that extra effort, find those stocks where something which market doesn't know.
So let me ask the panel, in the current market context, pockets which are well known, overvalued, whether you would still have comfort if you were buying fresh. I'm talking about the new people who are in. So for instance, consumer, something like Lever, some of its peers, and things which are trading at 60-70 times, would you have comfort?
No, as I said, you might have comfort in the sense that you won't lose money there, but you might end up after 5 years not making any money in the stock or not a lot of money. So, if you're going to sacrifice return for safety, you might as well buy bonds.
So, Raamdeo sir, if one were to force you to buy something that is anyway expensive and you know it's not at your price, in the current market, what would that overvalued pocket be that you could still go ahead and put something on?
It's not that there's no opportunity. There is opportunity, but it's not staring at you. Like, see, typically, the fun in last 25-30 years has been that you could get enough stocks to double your money in 3 years. That used to be my formula. That look at the stock, when you hit the opportunity, you're looking at a doubler. Later on, either it turns out to be a dud or it turns out to be 10 times. But when you start, there was clearly a case where business was reasonable, management was reasonable, growing rapidly, and available at 15, 17 P multiple or 12 P multiple. That kind of opportunity is not there right now. But still, if you want to make, so obviously, instead of 25%, I'm willing to take less than 20%, 18%, 17% kind of return. See, what is going to happen is that you keep buying what you like and what is right. Say, we call it QGLP. Quality stocks we keep buying, growth stock we keep buying. That I'm not going to compromise. In fact, I'm willing to compromise lower returns. Somewhere along the line, what will happen is that Indian economy, which is slow right now, will pick up steam. And it will surprise everybody. It's like, we don't know when it happens. Like in 2003, we thought that we were in wrong profession. And then what was knocking the door was the history's biggest bull market, 2003 to 2008. Yeah. So we don't know what is out there. Will it be because of the liquidity? Will it be because of the earnings growth? And why it will come? We don't know. But it happens, it knocks the door and it comes. And at that time, you don't have a full portfolio. You will be just bypassed. You can't be timing the market.
I want to move to the next thing, and that's the Q in your QGLP, quality, this whole concept, because we've been in an environment where we've seen a lot happen. We've seen companies, go through the roof with leverage. We've seen IBC happen. We've seen promoter issues happen. We've seen auditor resignations happen. Now, how do you start defining the Q? What all goes in Q? What are your check marks?
Yeah, so Q is very clear, very commonsensical. We have bifurcated into two: quality of business and quality of management. There are three types of businesses: great, good, gruesome. So you have a very good business, you have good business, and you have outright bad business. 90% of businesses are outright bad businesses. So if you can cut out that bad businesses, the companies which either make losses or make the profits less than cost of capital, 7%, 8%, and there's all the so-called textile companies, types, or sugar companies. Even a lot of cement companies are also like that. So they don't make money and they have the fancy names and kind of thing. If they don't make money, you're not going to make money, very clearly. And there are 80-90% of the companies, they come in that category. Then you have the good companies which earn about 18-19%, like all the well-run banking companies, finance companies, they're in about 20. Then you have great companies like 30-40 companies. Pardon?
Are they all well-run? The banking and finance companies?
Not all. Some of them. Some of them. Then you have the wonderful companies like Asian Paints, Hindustan Lever, Nestle. There are 25-30 companies like that. They are great companies. If you can get great company at a reasonable price, you are done. You need 4-5 stocks like that, your portfolio will do very well. But I try to make my entire portfolio of 15-20 companies filled with good companies or 1 or 2 great companies. And I make sure that there is no dud company in my portfolio, no bad businesses. 7-8% return on equity businesses, I just hate to have in my portfolios. And that's where people get stuck, because they look very cheap, but they're actually most expensive businesses.
Quality in today's context specifically, because there are a lot of issues happening. We're having, SEBI cases opened up and there are whistleblower issues coming up. So just how to ensure that what you are holding, you've done all the possible quality checks beyond what the P&L is telling you or beyond what the leverage levels are telling you.
See, I think in a tough market is when the boys and the men are separated. It's not something which is new. It happened in 2011, it happened in 2013, and now again it's happening in 2018. There are always, the market discovers these so-called low-quality businesses. I think the simplest method of defining quality at the first instance is, can a business earn a respectable return on capital, provided obviously you are confident that the numbers that you're looking at is something that you can rely on, obviously. So I'm taking that basic assumption and I'm not going beyond that. So for example, if a 10-year bond yield in India yields you 7.5%, which is the lowest risk investment you can make, the question we have to ask is, if a business cannot make 2x of a 10-year bond yield, do you really want to own that business for a long period of time? Now, temporarily it may be below that, but over your investment horizon, you should have a respectable return on capital. Quality also comes from discipline in capital allocation. And the third thing, which is the most important, is that does the business generate operating cash flows, right? And then over time, free cash flows. Because you may be doing all the good work, you may be doing all the good, great projects of the world, but if you can't convert your sales into operating cash flows, then there is no meaning, right? And then obviously there is things like management quality, which only you can, you have to go back in history and, look at how these managements have been disciplined about their capital allocation, and more importantly, how have they dealt with their minority shareholders? Very, very important, right? So if a business has issued capital several times, and if the shareholders have never made money, then you know that, it's not a great management. So quality has several aspects, some things which can be quantified, like return on capital, cash flow, and there are some things which you have to glean from the actions of the managements over time. And you have to look at companies, how they behave during good times and bad times. And that will tell you the quality of a business.
Rajashekar sir, your thoughts on quality. Also in the current context, I just wanted to know, as long-term investors, when something happens, when, let's say there is a corporate governance issue comes up, we've had that with one of the biggest pharma companies of not just India, of the world, there are unanswered questions. We don't know there is an investor call, but still it's unanswered and things like that. When there is, sort of management change, or at the promoter level, there's a change with one of the, youngest private sector banks of the country, and we've seen what's happened to the stock because of just too many uncertainties and unanswered issues. Do they also become quality red flags for you, or not until there is an impact on the real numbers? Still, there is an impact on, return on capital falling.
I think it's definitely a red flag because corporate governance issues can snowball into serious problems for the company itself. So while the more important thing you want to see in a company is the scalability of the business, the operational effectiveness of the management, the strategic capabilities of management, the corporate governance can result in a huge risk for the company itself. So all this will come to nothing, as we have seen in one or two cases, but they're not able to scale up. So if you don't have any problem, you have a smooth run, and that's how you compound over a period of time.
Hiren, what excites you the most? What is happening in this market? Where do you think the pulse is? And what do you see over the next, let's say, a year? Something that's really, taking your bone at the moment.
No, I think like everybody else here, I'm very, very bullish on India and markets in the long run. I think in my whatever 27 years that I've been in the markets, I mean, while change has been a constant, but if I really try and reflect, I think the amount of change that we've seen in the last 3, 4, 5 years, whether it is competition from e-commerce and new business models, whether it is regulatory change like DeMont, GST, IBC, I mean, businesses have really gone through very tough times in the last few years, right? And these cycles have happened in the past. I remember 96, 97 after the Asian crisis, manufacturing companies, nobody was willing to listen to them because everybody was making merry in tech companies, right? IT companies. But during that period, companies, when they go through a tough period, they become lean, they cut out all the mistakes, at least the good ones, right? And they become lean. And you never know when the economy takes off. So I think we've been waiting eternally for that earnings growth to happen and growth to pick up, which eventually it will. But I think whenever it does, I think companies have gone through such a grueling, volatile period over the last 3, 4 years that the ones that survive from here on will make disproportionate money going forward. So I'm quite confident. I think that the next 2, 3 years are likely to be good. I think even next year could be good. As I said, the template was that 2013 was a tough year, everything goes bad, headlines are bad, things are uncertain. You got to buy when there is uncertainty, because when you buy when there's full certainty, you got to pay a price for it, right? I mean, obviously you have to choose your stocks. So I'm confident.
The sector, theme, sector, stock of course you won't give, guys, don't bet on that. So, but the sector, the theme, an idea that's really exciting you.
No, I mean, again, we don't look so much at sectors, because even within a sector you have, good players and bad players. But I would say simply that I think capital goods could be interesting. I think corporate banks could be interesting if you look hard over there. These sectors haven't done anything for a long period of time. That could be interesting.
Raamdeo?
Yeah. I think the long-term trend of making 12 to 15% at index level, if you give long enough time, 5 years, 7 years, I don't think that story is bad. Still, the story is good. We have, if you look at if you leave aside the earnings part of it, which is depressed right now, for 4 years, total corporate earnings have not grown. That's a very sad part. So clearly why it will happen, I don't know, but the pendulum has to move from a zero earnings growth to some kind of earnings blast in next 4, 5, 6 years, maybe after 1 year, 2 years, I don't know. So that faith I have. And so that earnings growth is ahead. Our market cap to GDP of 70% has to go back to a parity or even higher than that. So I think we have but if you ask me 6 months, 1 year and all, I don't see anything happening.
No, I'm just asking you for the idea that excites you the most at present.
Yeah, so, like private sector banks. One of the themes which has made a lot of money to me and for everybody actually is the value migration. So value is migrating in current situation in the financial sector, which keeps growing at 15-17% from public sector to private sector. My sense is, I don't know, I've not spoken to any one of them, but well-run private sector banks must be having both sides opportunity. They must be they must be the liability taker of the choice, and they must be lender of the last resort. So they'll be able to take liability at a lower rate, and they'll be able to lend at 50, 60 bps higher. So I think if not in December, in March as well, we should see expansion of the margin. Maybe it is not permanent, but the opportunity for private sector lending and making money out of that is a lot, and stocks are not that expensive. That is another thing. So that aspect. Then even automotive looks to be pretty interesting. Consumer, anything in consumer in India.
You're worried about this whole slowdown talk, bad numbers during festive season, this, that?
Oh, chalta hai. Like, I don't think, you should be worried about a quarter here and there. Sometimes it is base effects. And analysts also, they're crazy. They don't like good results, and in bad results, they find optimism. So, so you will not be able to make out what they're saying. You have to live with because they are concerned about being right in next quarter. But as an investor, we have to be right in next 3, 5, 10 years. So there is a huge difference in what they write for every quarter. And so we have to be very, very careful. We should not be too much carried away by very good quarterly result, and should also not be completely disappointed by very bad one quarter.
Bad quarter. Fair enough.
So, but I think India is on a growth path. Even a bad growth is 7.5%. We have, one of the biggest change I see is that now inflation is sub 3%. It's crazy. This country should buy inflation, actually, and they can. Now with the change in the central bank, I hope if they cannot do anything, at least they must buy growth, and the buying growth could mean a little higher inflation. Even the great guy has said 4% plus -2. I think they listen to only -2, not to +2. So I hope they're able to. Creating jobs is the paramount need.
It's time to spur growth.
Yeah, spur growth so that jobs can be created.
Okay, I'm pretty sure New Delhi agrees with you.
Yeah, New Delhi, but I don't know whether Mumbai guys agree with them or not.
We'll find out in the days to come.
Yeah.
So very quickly, last thoughts on what excites you the most, the idea for the moment.
No, as earlier also said, I think there is definitely a shift happening from larger number of companies doing well to fewer number of companies doing well. So there's a concentration of growth in fewer companies. So it's going to happen. India will build some really big companies which overcome all the problems we had in the past. I think the underinvestment in the sector is enormous. I'm talking about the stock market itself. So in 1992, we had as much as 17% of household savings going into stocks. It dropped to as little as 3-4% after the scam and all that. I don't know where it is now, but I wouldn't be surprised it was like 10-12%. I don't know. So I think there is still a lot more money which can come into the stock market, provided there are good enough companies to absorb that. And I'm not a big believer that it's government which drives growth. I think it is people's aspirations. And there is an entrepreneurial class in India which takes advantage of opportunities. So over the next 10, 15, 20 years, you'll find companies growing enough money to finance that growth from investors. So it'll keep changing.